Let's talk about VA loans, but not the surface level stuff you hear everywhere, not just the zero down, no PMI, great benefit, because all of that is true, but there's a piece of this that almost nobody really explains properly, and that's the VA funding fee. Most people hear no mortgage insurance and assume this is automatically the cheapest option, and sometimes it is, but not always for the reasons people think. But here's what's actually happening behind the scenes. You're not paying PMI monthly, but you are paying something up front. And most of the time, you're financing it. So in this video, I'm going to break down exactly what the VA funding fee actually is, how it impacts your loan amount and payment, how it compares to PMI loans, when it makes sense, and how to use it strategically. So you're not just using your benefit, you're using it correctly. What the funding fee actually is. Let's simplify this first. The VA funding fee is a one-time fee charged on VA loans designed to keep the program self-sustaining. It replaces mortgage insurance. So the key point here is instead of paying monthly a PMI or private mortgage insurance, you pay a one-time fee. The typical range for most first-time VA users with zero down, now keep in mind this may vary, depending on each individual case, but for the most part, it's about 2.15% of the loan amount. So a real example, let's say you buy a $300,000 home, which includes the 2.15% funding fee, amounts to $6,450 as part of the loan. Now here's the key part. Most people don't pay this out of pocket. They roll it into the loan. So now the loan amount is not $300,000, it is $306,450. And this is where people lose visibility because they think I bought a $300,000 home, but they're actually financing more than that. And how that matters, especially again, given each situation, is going to impact your decision on what you want to do in the future. Because if you don't plan on keeping the home long term, you're going to move out, if you're PCSing, etc., that all comes into play when thinking about all this. But more on that later. So how this affects your payment. Let's break it down in real terms. Without the funding fee, the total loan amount would be $300,000. With the funding fee financed, the loan is $306,450. That's a $6,450 difference. Now spread that over 30 years at 6.5 interest, which is what's currently around the market, give or take. It's been fluctuating, but at the time of this video, let's say 6.5% interest. You're paying interest on that fee as well. So what this means is your payment is slightly higher because you financed the fee and you're paying interest on it over time. But here's the really important part. Even with that increase, VA loans often still outperform conventional loans with PMI, and in my humble opinion, there is still no better loan out there than the VA loan. So VA loan versus conventional. Let's do a real comparison. So this is where we actually compare apples to apples. Let's go back to our scenario of a $300,000 home. Option one is the VA loan. 0% down. The loan amount with the funding fee is $306,450, but no PMI. Option two is the conventional with 5% down. So that means $15,000 down. The loan amount is $285,000, but because it is less than 20% down, it includes PMI. So here's the trade-off. The VA loan, although it is a higher amount, there isn't any PMI. And with the conventional, you do have a lower amount for the loan. However, your monthly PMI has to be included. The PMI example could be $150 to $250 a month, depending on your credit profile, etc. There's lots of variables. Each individual case is different. But the big insight here is with the VA loan, you pay more upfront, which is financed, but you avoid the monthly drag. Now with conventional, you pay less upfront in the loan, but you bleed monthly through PMI. So if you think long-term here, PMI can last several years or throughout the life of the loan, depending on the loan type. For FHA as an example, And with the funding fee, it's only paid once. So this is the key difference. The VA is front-loaded cost. It's financed. The conventional, it's an ongoing monthly cost. When the VA loan actually wins. So VA tends to win when you want to preserve cash. So no down payment means you have more liquidity and you have more cash on hand, which in the real estate game, to be quite honest, I'm a big fan of. Leverage means other people's money. So the more you can keep in your pocket when moving into a home, the better, because then you kind of use time as your equity builder, and really you turn your time into a bank, if that makes sense. So that is a big one. Cash is king, so you get to keep more of that in your pocket when you're moving into a home. Especially, we'll get into some scenarios later on in the video, but another reason is you don't want PMI. So you lower your monthly obligation, which again, this is a big win because it's upfront instead over time. So that's another win. And here's the big one. You plan on holding the loan because the one-time fee gets spread out over time. But this is why I brought up earlier, depending on your situation, because let's face it, VA loans are for veterans and active duty military, which again, PCSing comes to mind. So if you're going to plan on moving and not hold on to the loan in the house, we really got to sit down and walk that through, because the fact that you are front loading the cost means you typically are going to be underwater, if that makes sense, for the immediate and short-term onset of the loan. After time, yes, it'll even itself out, but within a 3-year spread, you really have to do your numbers very carefully. The reason being is, let's get into an example. If you keep the home, let's say 5 to 10 years, the VA advantage becomes very clear. So when should you think twice? Let's be real. VA loan may not always be the perfect answer, even though it is a fantastic loan. And like I said, in my opinion, it is the best loan. It may not always be the perfect answer. Why? Short hold time. And again, I spoke on this earlier, but if you're not going to keep it long term, meaning 5 to 10 years, if you're planning on selling quickly or refinancing quickly, you may not get the full benefit from that funding fee. Again, think long term, right? Letting your time, do the leverage for you and increase your equity. So another one is the higher price points lead to a higher funding fee because it's a percentage of the sales price or the price of the home. The disability exemption is important. For some veterans, they do not pay the funding fee. If that's you, then the VA loan becomes even stronger. So how's the strategy and how to actually use it the right way? Don't just focus on VA versus conventional. Focus on total cost over time and your monthly payment comfort. So what's the real power move? Use the VA loan to keep your cash and negotiate seller concessions so that you can buy down your rate. Don't use it in order to stretch your purchase price. So yes, the VA loan is one of the best tools available, hands down, but the funding fee is the part that most people overlook. And it's not a bad thing. It's just something that you need to understand, because when you understand it, you will make better decisions. You structure your deal accordingly and correctly, and you stay in control. So if you want to actually run your numbers one-on-one and see how this plays out for your specific situation, feel free to reach out. Links on how to contact me down below. But as always, I hope you found this video helpful. Life is good. Always make it count.